Inflation has come down significantly but remains above the 4% target. Food inflation continues to exhibit considerable volatility, which is impeding the ongoing disinflation process. High and persistent food inflation could unhinge anchoring of inflation expectations, which is underway. Our ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth momentum, together with our GDP projections for 24-25, give us the policy space to unwaveringly focus on price stability. Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task remains unfinished. The success in the disinflation process so far should not distract us from vulnerability of the inflation trajectory to the frequent incidence of supply-side shocks. Our effort is to ensure price stability on an enduring basis, paving the way for sustained period of high growth. I would now like to turn to the aspect of liquidity and financial market conditions. In the February monetary policy statement, if you recall, I had mentioned that liquidity conditions were driven by exogenous factors which were likely to correct in the foreseeable future. Liquidity conditions eased during February and March in the wake of increased government spending, Reserve Bank's market operations, and the return leg of US dollar and Indian rupee sale by swap auction, which had been done earlier in 2022. In particular, liquidity situation improved in March, with system liquidity turning intermittently surplus in the first half of the month. In these circumstances, the Reserve Bank conducted 14 fine-tuning variable rate repo operations, that is VRRR operations, during February and early March to absorb intermittent surplus liquidity. Anticipating the seasonal tightening of liquidity at end March, the Reserve Bank injected liquidity through variable rate, that is VRR operations, both main and fine-tuning operations. Consequently, the average borrowings under the MSF window moderated. Liquidity conditions have, however, again turned surplus from March 30th, necessitating VRR auctions from 2nd of April. So you would have noticed in the last 2-3 days, we have been conducting more than one VRRR auctions. On 2nd April, then again we did it on 3rd April. So last 2-3 days we have been doing it. And today, as you know, there is a variable rate. There is a what you call, as per our cycle, we are doing VRR operation for 14 days. A VRRR operation for 14 days. Now, reflecting these liquidity developments, the weighted average call rate, that is WACR, exhibited a softening bias and has hovered near the repo rate since the last policy meeting. In tandem, rates in the collateralized segment of the call money market have also softened. Financial conditions remained conducive, as reflected in reduced term spread in the G-Sec market and stable risk premium in the bond market. In the credit market, monetary transmission continues to be work in progress. Looking ahead, the Reserve Bank will remain nimble and flexible in its liquidity management through both main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner that preserves financial stability. The Indian rupee has remained largely range-bound as compared to both its emerging market peers and a few advanced economies during the financial year 2023-24, that is till 31st March last. The Indian rupee was the most stable among major currencies during this period. This is very important. The Indian rupee was the most stable among major currencies during this period. As compared to previous 3 years, the Indian rupee exhibited lowest volatility in 2023-24. The relative stability of the Indian rupee, which I just mentioned, it reflects, I would emphasize, the relative stability of the Indian rupee reflects India's sound macroeconomic fundamentals, financial stability, and improvements in our external position. Turning to financial stability, let me say that latest data as at end December 2023 show that the key indicators of capital and asset quality of scheduled commercial banks continued to be healthy. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. Let me emphasize here that banks, NBFCs and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. Financial sector players by and large operate with public money, be it of depositors in banks and select NBFCs or investors in bonds and other financial instruments. They should always be mindful of this aspect. The Reserve Bank will continue to constructively engage with financial entities in this regard. It needs to be recognized that financial stability is a joint responsibility of all stakeholders. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority RRA 2.0 constituted by the Reserve Bank have been largely implemented. The RRA 2.0 has set a new benchmark for meaningful engagement between the regulator and the regulated entities. Moving further in the same direction, internal review groups within RBI were formed in 2023 to rationalize, simplify and remove obsolete regulations and streamline the reporting mechanism. In pursuance of the recommendations of the RRA 2.0, that is the Regulations Review Authority which was constituted by the RBI. So in pursuance of the recommendations of the RRA 2.0 and the internal review groups which we constituted in 2023, more than 1,000 circulars have been withdrawn. A master direction for rationalizing and harmonizing supervisory returns has also been issued. The Reserve Bank will continue to follow a consultative approach and undertake review of regulations in line with the evolving financial landscape. Turning to external sector, during the first 3 quarters of 23-24, India's current account deficit narrowed significantly on account of a moderation in merchandise trade deficit, coupled with robust growth in services exports and strong remittances. India's merchandise and services exports have grown at a healthy pace in the 4th quarter of 23-24. India continues to be the largest recipient of remittances in the world. The cost of receiving remittances is gradually coming down. Overall, the current account deficit for 2024-25 is expected to remain at a level that is both viable and eminently manageable. On the external financing side, India's foreign portfolio investment, that is FPI flows, saw a significant turnaround in 23-24. Net FPI inflows stood at $41.6 billion during 23-24, as against net outflows in the preceding 2 years, which were in the order of 14.1 billion outflow in 21-22 and 4.8 billion outflow in 22-23. This is the second highest level of FPI inflow after 23-24. Net foreign direct investment moderated to US $14.2 billion in April-January 23-24 from 25 billion a year ago. External commercial borrowings, that is ECBs, and non-resident deposits recorded higher net inflows compared to the previous year. The amount of ECB agreements also grew markedly in 2023-24 up to February 24. Now, all this data is given, details are given in the footnote. India's foreign exchange reserves reached an all-time high of $645.6 billion US dollars as of March 29th this year, March 29, 2024. I repeat, India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29, 2024. Latest data on various external vulnerability indicators suggest improved resilience of India's external sector. We remain confident of meeting our external financing requirements comfortably. Now, talking about the forex reserves, I recall that in 2021, our forex reserves had also reached 642 plus billion US dollars. Then following the commencement of the war in Ukraine and the outflow of dollar from India as well as from several other countries on safe haven demand, there were concerns that forex reserves of India was going down, and at one point it had gone down. Our forex reserves had gone down to about $524 billion. And at that time, I think several questions were raised about, what was RBI doing, whether RBI was on the right track. If you recall, at that time, we had very clearly assured that the decline in forex reserves was partly due to, the change in valuations of our assets, and also partly due to our intervention in the market to ensure an orderly depreciation of the rupee, which is a part of our policy, ensuring orderly depreciation or orderly appreciation. And we had that time very clearly and firmly stated that we are using our forex reserves in a very judicious manner. It was a strong umbrella which we had built up, and we are using it because it was raining heavily. And we were mindful of what we were doing. We knew what is our purpose and in which direction we are moving. And as you would see, now the reserves have again risen, and they stand at an all-time high of 642.6 billion US dollars, 645.6 billion as of 29th March. So, this is one area on which the Reserve Bank remains committed. Number one, to sort of ensure that, the exchange rate of the rupee is market determined. There are inflows and outflows of dollars happening, but it is our focus, it is our prime focus to build up a strong umbrella, a strong buffer in the form of a substantial quantum of forex reserves, which will help us when the cycle turns or when it rains heavily.